Thank you, everyone, and thank you to all of our speakers who preceded me. This session is on how artificial intelligence is transforming the enterprise. This is actually the third time AI has been a central theme in our technology panel at the conference, and it's fair to say that things have moved on extraordinarily quickly since then. Fraser actually discussed earlier how he discussed the rapid growth of the S&P's largest companies and how that was founded on very strong people. The other factor behind that is exposure to structural growth trends has been such a key driver behind the extreme value creation. And no structural growth trend has moved faster or created value quicker than artificial intelligence. It's quite frightening to think that 10 years ago, NVIDIA was capitalized at around about 25 billion market cap. Now it's somewhere between 4 and 5 billion. And actually, 10 years before that, it was down at sort of 2-3 billion. So what's happened recently? Over the course of the last 12 months, we've seen a significant further appreciation in the global semiconductor sector. So value creation has actually moved beyond NVIDIA. NVIDIA has actually underperformed the semiconductor industry, but the semiconductor index. But if you invested in the Philadelphia Semiconductor Index, you'd have seen over 150% increase in value, whereas NVIDIA's increased by around about 78%. And what we've seen is other players come to the party. So whereas a couple of years ago, people like NVIDIA or AMD were seen as being potentially threatened by the growth of NVIDIA and not well exposed to AI, they have evolved their product sets, and we're moving to a much more heterogeneous environment, as Fred will talk about, where many other players in semiconductor industry, photonics and related industries related to this semiconductor capex are now performing very strongly. At the same time, the Bessemer SaaS index, the cloud software index, has decreased by 15%. So the bet recently has been very significantly on the picks and shovels players, the infrastructure players, where people are very nervous about the software industry and the role that they have to play in the future landscape. So where do we go from here? Well, the good thing is we've got a fantastic panel who are going to talk us through different elements and look at this issue from different angles. We've got two investors, Fred from Polar Capital and Phoebe from Moulton, who invest into technology stocks that are exposed to AI, implementing AI, picks and shovels, semiconductors businesses, and they will give a great perspective on how they are seeing the investment environment from here and where they are putting their capital and supporting their businesses from here. We've got Louise from Trustpilot. One of the interesting things that we're seeing right now is we are now actually seeing AI have a real impact with some companies. And in some companies we're not seeing any impact. But Trustpilot was actually the 5th most referenced domain on ChatGPT in January. So it's a business that clearly seems to be on the right side of artificial intelligence, which as an analyst is something that's consuming a lot of our time at the moment. And we've got Samir from Capita. So Samir is pivotal towards to Capita's AI strategy, and he's going to discuss with us why perhaps we're seeing a rotation of value, and as value shifts more towards business processes rather than coding, why the business process outsourcing industry is potentially very well placed. So again, many thanks for joining us today, and now I'd like to hand over to our first panelist, Fred from Polar Capital Technology Trust.
Of course, thank you very much. It's great to be here.
Project to come on.
Sorry? Oh, you can stand up. Yeah, I can do it from the lectern. So I'm Fred Holt. I'm the semiconductor analyst on the Polar Capital Technology team. We are one of the largest technology teams in Europe. We run around 30-odd billion across 3 strategies. Got a mutual fund, a FTSE 100 listed investment trust, and also an artificial intelligence fund. Now that fund was launched around 8 years ago, the Artificial Intelligence Fund, which is a global equity product rather than a tech fund. But it's given us as a team of 12 fund managers and analysts, a sort of front row seat, if you like, on the development of this technology over the last 8 years, but also crucially over the last 2 or 3 years as we've had the launch of ChatGPT and we've started to see AI disruption ramp up. The way that we invest is we typically think about an S-curve. We don't do what we would term public market venture capital, sort of very, very early ideas, sort of areas of hubris, and we tend to not think about companies on the right hand of that S-curve, which is what we would sort of term incumbents, companies and sectors that are going ex-growth. Our aim is to be in that sweet spot of the S-curve, which is exactly where we think generative AI is now and why we're starting to see inflections in many of the companies that we talked about. I think there's 3 things I want to highlight and 3 things that keep us generally bullish on this trade and why we've been so positive on AI and the developments we've seen in the last few years. Firstly, it would be that the models are progressing. They continue to get better and more capable. And the main reason for that is that what we call the scaling laws, which is essentially the ability to add more compute, means that these models are getting better. And there's 2 or 3 different laws. There's pre-training, where we add more data and more compute, and we train the model to what we train the base model. And then we would do what's called post-training, which is sort of reinforcement learning, a kind of Pavlovian conditioning, if you like, of the model. And again, that takes an incremental amount of compute, and the model gets better. And then reasoning models. So these are models that can think, that can iterate, that can check their own work. And again, that takes another incremental level of compute. But those 3 vectors, those three scaling laws, continue to improve, and we're continuing to see returns to that, and the models are becoming more capable. As a result of that, the models are making fewer mistakes. If you think back 2 or 3 years ago when ChatGPT came out, you asked how many R's in the word strawberry, it would get that wrong. But now the models are continuing to get better, more capable, are scoring well beyond humans in most benchmarks. And to that end, the models are not commoditizing. So again, this was a worry 2 or 3 years ago that all these models would be the same. And if you look on most of the highest end benchmarks, the frontier labs and the frontier models have very, very different pricing. So you use tokens, which is effectively the currency of LLMs, and per $1 million of tokens, the top models are orders of magnitude more expensive. And to us, that tells us that the models are not commoditizing. And alongside those models getting more capable, what we're starting to see is revenue come through. Anthropic have just hit $35 billion in annual recurring revenue. The FT reported last week that they're up to 45, unconfirmed as of yet by the company, but up to 45. These guys are adding the annual recurring revenue of more than some of the largest companies in the S&P in months. OpenAI are around $25 billion, and we're starting to see cloud revenues at all the major cloud hyperscalers inflect meaningfully. Google is mid-60s, Amazon high 20s, Microsoft Azure mid-30s. And the reason these companies are starting to see some of these revenues come through is because as those models become more capable, the scope or the aperture of the economically valuable tasks that these models can do is increasing rapidly. On GPT-2, GPT-3, the early models 2 or 3 years ago, these models were kind of nice, maybe a complement to your workflows. They could answer simple questions, tasks that would take you or I 2 or 3 minutes. Now these models are able to do tasks that take you 12, 13, 14 hours. And it's that inflection in the task horizon that really means these models are becoming more capable, making fewer mistakes, and therefore you're starting to see revenues and enterprise adoption. Our base case from here is that this disruption accelerates. So coding and agentic AI has been one of the early use cases of some of these models, and the marginal cost of code is tending towards 0. And so what that means is you start to see companies that have been built on code bases over the last 20, 30 years. This is why you're seeing the disruption in those companies. Now, again, these companies don't go to 0, but you're starting to see a repricing in what those companies are valued on in the market. Other thing we would highlight would be this transition from what we would call the information age to the cognition age. So the last 10 years or so, it has been about collating data, collecting it, cleaning it, synthesizing it, presenting it to you and I as humans to do something with. And now we're moving into the cognition age or the intelligence age, where it is not just collecting that data for us to use, it is deriving intelligence from that data for agents to use as well. And it's that transition from information collection to intelligence, which is what we're seeing by the capability of these models continue to improve. It'd be remiss to not talk about some of the risks that we're thinking about. Obviously, technology and the scaling of these models continues to be something that underpins our bullish view, and we continue to see returns to those scaling laws, but any slowdown in that would be something that would concern us. Physical, sure we can talk about it, but there's issues around power, getting enough chips, getting enough data centers to install these chips in to run these models. Geopolitics, obviously what's happening in the Middle East, what may happen with China and Taiwan down the road. Regulation, something we get asked a lot about. How long will the US government let the Silicon Valley tech bros be the governor of this technology? We've already seen it with Anthropic's Mythos, their latest model, which Anthropic have a lot of marketing, or have a history of being quite funny marketers, but it was severe enough for Scott Besson to ask every US bank CEO to come to a room to talk about the power of this model. And finally, players dropping out of the race. So this is certainly a race at the moment. We're seeing the frontier labs of Google, Anthropic, and OpenAI leading that race. XAI, Meta, somewhat behind. TPC, the capabilities of the models they can produce. But at the moment, this is a race because these models are getting better and better. And again, they're opening the aperture of the economically valuable tasks that these models can address. And finally, timing. And perhaps this is the most important one. If any of you heard Dario Amodi speak recently, who's the CEO of Anthropic, he says his biggest worry is the timing of ramping these revenues and ramping the infrastructure at the same time. So this is obviously a lot of infrastructure and investment that has to happen ahead of these revenues. So despite all those risks, we still remain very bullish as these models continue to get more capable, and happy to chat a little bit more about it in the Q&A as well. Thank you.
Thank you, Fred. I should mention that not Fred, but Polar were here last year, where we had quite a healthy debate about whether it's time to rotate into software from hardware, and clearly, well, Fred heads up he looks at the semiconductor sector within Polar, but they have remained significantly overweight in semis, and I think historically underweight in software at the moment as well. So we can explore that in a little bit more depth later. We're now going to have Louise Bryant, who's head of investor relations at Trustpilot. So Trustpilot, as we discussed earlier, is a business that are seeing significant increased exposure through the LLMs. But the company also had a very, very interesting investor day last week, where they explained how they are leveraging AI in terms of building trust within the enterprise, and also on the threat side, how AI is making the challenge is increasing the volume of fake reviews. It makes it much easier to spread fake information, and how they are using technology to combat that. So, Louise, if I can hand over to you. Thank you.
Morning, everyone. So some of you may have seen the green stars around London and know who Trustpilot is. Forgive me for those of you that don't. But Trustpilot was founded in 2007 as a place for consumers to leave their feedback about businesses, and actually for businesses to respond to that feedback and have the ability to learn and improve from it. And our monetization model, just for kind of clarity, is subscription. So businesses can pay in order to use Trustpilot in their marketing. That's what you're seeing all around London on the tube. But also to ask for feedback at scale, so to automate that invitation process, to get volume of reviews, and then to get insights from those reviews. But specifically from a kind of an AI perspective, we're an open platform, so anybody can go and leave a review on Trustpilot. You don't, as long as you've had a genuine experience with a business, you don't actually have to have had a transaction. But that brings challenges, because to Dan's point, it means that bad actors can try and game the system. And so we think about using AI in three areas, and I'll take each of them in turn. The first is very much from that fraud and moderation perspective. So we have an applied AI team within our trust team, which is about over 200 people. And that applied AI team have been using the early variants of LLMs, heuristics, and other types of models, neural language processing models, for over 10 years, and actually were using the very same technology that ChatGPT is based upon at the same time that ChatGPT was launched. And what we're doing, or what that team is doing, is that they're looking at the metadata points behind every review that's submitted. So if you think about whether a review is fake, you might read something and think, well, that doesn't look quite right. Actually, we're only looking, content is only about 5% of the data points that we're looking at when we decide whether or not a review is genuine or not. And the rest of it is these hundreds of metadata points that are being collected about you, the reviewer, as an individual, when you're submitting that review. So things like your IP address, your email address, whether you're connected to other reviewers who've left reviews for other businesses in the past, whether you've left reviews for other businesses in the past, the time of day, the language of your operating system, even down to the percentage of battery on your phone or computer that's leaving that review. And so AI has enabled us to look for patterns in that data that would have been much more difficult to do when it was humans previously. And so that's allowed us to take far more fake content off the platform. Last year we took about 9.5% of reviews off the platform, which is about 7.8 million. We have over 60 million reviews submitted in a year, and over the kind of entire lifetime of Trustpilot, we've got over 360 million reviews on the platform and about 200,000 being submitted a day. And clearly, when you're operating at that scale, you need to be able to leverage technology in order to make those decisions quickly. There's a 2-hour posting delay between somebody submitting a review and actually that being posted to the platform, and it's in that 2-hour period that these machine learning technologies are running and assessing that review. So moderation is kind of the number one area we've been using, and it's allowing us to scale incredibly quickly. The second area is kind of operational efficiencies, I would say, and for us as a tech company, that's predominantly around coding. So we've been using Claude Code in the business for a year or so now, and the engineering teams are seeing huge efficiencies, particularly actually when it comes to things like clearing up legacy code. So issues that we might have known existed in old code, but people have either not had the time to look at, or when they've looked at it, it's been too complicated and not been able to fix. And we had an instance a couple of weeks ago where a very junior coder, fairly new to the team, looked at a piece of legacy code that all the senior people on the team hadn't been able to kind of fix for a period of time, and he solved it in less than an hour using Claude Code. And so that's the kind of level of efficiency that we're starting to see come through, and is really exciting. It should allow us over time to develop product and release that faster and quicker for our customers. There's clearly the broader efficiency that everybody talks about, in other functions. And in finance, for example, I've been using Claude to help me write my board papers, which I'm thrilled about because it's gone from hours to kind of about an hour to get at least a first draft, which makes life a lot better for me. But the point that Dan was talking about, and the kind of third area that's really important for us as a business, is that with AI, we've kind of got this paradox where AI is enabling content to be written kind of freely and easily at scale. But actually, in doing so, it's making it much harder for you as an individual to know what you can trust, because you don't know whether or not something's been written by a human or whether or not it's been written by a bot, and therefore whether it's genuine or not. It's deep fakes, those sorts of things. And so actually, for us at Trustpilot, we see this as a huge opportunity, because as the world moves more to agentic commerce, people transacting and allowing agents to transact on their behalf, or even not, even just you wanting to go and, buy a piece of furniture or choose which insurance product to use, you want to know that the other people that are have used that product in the past are real and genuine, and you're not being sold something that either doesn't exist, is a scam, and that actually you're getting value for money. And particularly when you're making what we call higher lifetime value purchases, that becomes even more important. And so what we are doing, and what we see with AI, is that the AI models are looking for relevance and recency in particular. So they want content that helps them surface useful information to the consumers that are looking at it. And they want that continuously refreshed content. And that's where reviews, being third-party content, not something that a brand itself is putting out there, and the fact that reviews are constantly coming into the platform, as I said, nearly 200,000 a day, that recency and that richness of content becomes hugely valuable to those AI models. And as a result, as Dan mentioned earlier, we were the 5th most cited business globally on ChatGPT in January this year. And we've actually just undertaken some research, which I can't talk about because it's being published tomorrow, but kind of high level demonstrates that actually Trustpilot is effectively the most trusted review platform out there, and that's what all these large language models are tending to rely on for review purposes. And so for us as a business, we're incredibly excited because clearly businesses are having to find new ways to connect directly with consumers through AI, through large language models. And therefore, having something like genuine customer reviews to be cited and help raise your profile within, you need to be within the kind of top 3 or 4 things listed when AI search gives you something. And Trustpilot is repeatedly surfacing businesses that have strong review content on the platform. And so for us, we see AI as a huge opportunity. So I guess in summary, I would say there are 3 areas particular to us. First of all, the content moderation allows us to keep the platform safe. Secondly, the growth prospects for us because of the way that reviews are being surfaced in large language models. And thirdly, similar to most businesses, we are seeing kind of significant efficiencies starting to come through, which is great for us. And so we are very happy with our prospects ahead. With that, I'll hand back.
Thank you, Louise. And the AI aside, it certainly seemed to me like a business that's benefiting from stronger and stronger network effects as your platform grows, your visibility grows, and your trust reputation grows. Actually, similar to Trustpilot, Edison also has an open access model. We've actually recently seen ChatGPT overtake social media as a referral to our website. And actually, when you consider how many, that only sort of looks at the people who are clicking to the website. When you consider how many dialogues that is influencing, then it's probably a multiple of that. And one of our big sort of investment themes is that companies need to be understood by the LLMs. They need to make themselves understood to the machine, if you like, as well as directly to humans, which is something Edison is very focused on. So next up, we've got Samir Voyuru, who is Chief AI and Product Officer at Capita. So Samir is leading the company's AI-driven transformation. Samir actually joined the business from senior roles at AWS and has founded his own technology business in the past. So he'll explain a little bit why he made that move and why business process outsourcing is an interesting place to be.
Good morning, everyone. Samir Voyuru. I've been at Capita for 18 months now, joined from AWS, as Dan mentioned. And I want to start off with why I joined, because I think it's illustrative. I ran the global telco vertical at AWS, so roughly 2,500 telcos globally. And I used to go to every one of these telcos and say, every one of your processes, we can agentify now that we have the tools. Great, come on in. Here's my standard operating procedure. This is how we do things. Go agentify it. A week later, it's agentified and deployed. A week later, it's failed. And the reason it's failed is a standard operating procedure had absolutely no correlation to what was actually happening in real life. That standard operating procedure had taken on a life of its own and had spawned 1,000 variants. And each 1,000 had spawned another 1,000. And the people who were actually doing the work were not the telcos. They were the business process outsourcers who were serving the telcos. And each person had adapted that process to his or her own ways of working. And so that's why RPA failed in the past. And that's why we believe that agentification will succeed, because agents think, robotic process automation did not think. It was linear. So we see 3 big opportunities from the view of a business process outsourcer. So if you don't know what Capita does, you probably interacted with us when you took Transport for London, especially if you drove in. We were on the road user charging. If you paid your BBC TV license, there's us that collected it. If you haven't, please do. All right. So we touch about 70% of the UK's population in one form or another every single week. So we see three big themes. One is we run incredibly complex processes. One of our processes used to be run with over 2,000 cut and pastes and 400 spreadsheets, give or take. Imagine agentifying that and letting an agent do the work. So that is well within our gift and within our control to agentify the complex processes that we run. And we should talk about that in the context of the SaaS companies when we ask the questions. Number two, we are starting to see the concept of forward deployed operators. Forward deployed engineers was a term coined by Palantir, adapted by Anthropic and all of these other companies, to go and land AI in companies with people who actually knew how to deploy it and how to tune it and how to make it stick. And so they have grown incredibly. For example, Scale.ai, which is now part of Meta, was essentially forward deployed engineers implementing AI, a new generation SI company. It has now transitioned to what we now call forward deployed operators. Because once that AI use case is in beta production, that needs to be taken care of for the next decade for that enterprise. And these companies are not going to do that because the agent will drift. There'll be new LLMs that come in. There'll be new data that comes in. The data's going to expire. It's going to need to be refreshed. So there's a lot of feed and caring of agents in the wild that someone needs to do. And that is a big opportunity that we see. And the third one is because of the coding apocalypse, we are starting to see that a lot of the SIs who have historically implemented these really complex systems are starting to see their value deteriorate. I had a quote come in from a large SI to do a deployment of an application. They were going to charge me £650,000 and take 9 months to deliver it. I coded that in the meeting in front of them and showed it to them for 30 minutes later. There is massive value destruction that is going to happen in the SI industry. And in the SaaS companies, I think that's going to translate into the professional services layer, where these professional services contracts, which are very, very lucrative for them, are going to start getting affected by others who are starting to vibe code that. So those are the three big areas that we see and that we are looking to enter into and grow as a modern business process outsourcer. Thank you.
Thank you, Samir. Very interesting perspective there. So next on, we've got Phoebe Kitchen, who's a principal at Molten Ventures. So Molten Ventures are a leading European venture capital firm, backing high-growth technology companies from Series A to IPO. Actually, on our firm, Molten have presented at every one of our Edison growth conferences. And at our first conference, we discussed how the UK is actually, certainly was at the time, I don't think we've changed much, but we're rated number 3 in terms of AI expertise, AI capital, and so on. And one of the things we urged the UK investment community to do was to back that and to really make sure that we help these companies grow and that we benefit from the growth that these businesses create. And obviously Molten are very central to that. So Phoebe, if I can hand over to you.
So thanks a lot for the great introduction. I think maybe high level a bit about Molten, what we do. So I think we provide a bit more on this panel, some of like the earlier stage perspective. So we're a venture capital fund, which means we invest in companies Series A to Series C primarily. So these are companies between 1 to just say 20, 30 million of ARR. And I think from this panel, the sort of key areas I want to discuss is really, one, what are the trends that we're seeing in AI? What are we most excited about? There's been a lot of great discourse around the sort of later stage public markets, how you can play cloud infrastructure, et cetera. But for us, it's really thinking about where can these new companies really add enormous value within this ecosystem. So I think it's great, obviously seen from this panel, is that there is a lot of exuberance around AI, but also the value created is real and material, particularly at the enterprise level. I think we've seen that already in the panels today, both how you can adopt that in existing enterprises from a cost perspective, and also, frankly, further accelerate your top line. You've already seen great, particularly European champions evolve who are truly AI native. So you have companies like Legora, Mistral, Black Forest Labs, at all these different stages of the value chain. So from application layer to the middleware to infrastructure, where we expect there'll be significant more innovation to continue. In terms of, I guess, where we're most excited about looking at AI companies, I think there's really much a fragmentation between what are the workflows that drive material value. So for instance, now if you're a software company and you're essentially a workflow automation layer, it's pretty difficult to compete against what we're seeing with a lot of these large language models. So that goes to where do we think defensibility can really be built? A lot of that is either proprietary data, if you're a regulated company, so for instance in financial services, healthcare, and the same is true in terms of how mission critical and sticky you are within existing systems. So in some ways, how we frame and view technologies is in some ways the same of what we did for software first companies. Then for AI, what we're really excited about, I think one is we've discussed before, is the ability to build net new infrastructure. So this is both from a semiconductor perspective, so the UK in particular has seen great new companies emerge, so Olex, Fractal, who are essentially trying to build next generation solutions around AI inference. That's one of the biggest bottlenecks today. The second is obviously foundational models. You have European first models like a Mistral, et cetera, as well, and also those who sort of sit between the infrastructure layer and middleware layer. So you have companies like Synthesia, 11 Labs, who are really building the multimodality for video, voice, et cetera. So essentially creating completely net new categories. The second layer is, as Molten, as a venture fund, we're very much thematic-led investors. So I spend most of my time actually on financial services, but my colleagues also focus on healthcare, industrial, AI, software, et cetera. And the next part of really where AI is exciting is really that layer. And like where you win is like a really deep understanding of customer workflows and behaviors. So you see some winners emerge in certain verticals already. So legal is obviously a big one already. You see this also in financial services where people are building these vertical solutions just for specific industries. And we expect that will continue. You've already seen European companies do very well in that space. So Legora is obviously one. The second is anything around augmenting existing workflows. So for instance, we think about trends such as agentic commerce that has already been mentioned, personalized medicine as well in healthcare, and also the same is true across more broadly financial services and enterprise productivity tools. And the last area, which maybe hasn't actually been discussed as much, is in an era where AIs effectively can automate all workflows, it fundamentally also can reimagine how we see value for services-based businesses. So now it's, instead of, as has already been mentioned, professional services is going to come under a lot of pressure over the next few years. We're focused on, can you build sort of an AI lawyer or an AI accountant, an AI auditor? So it's repackaging what it means as a customer to like fundamentally deliver that ROI and really build into this like outcome-based pricing. So that's one part. And the second part really is services, is that you're tapping into a much bigger market and pool of spend. So you're tapping into essentially spend of people versus spend of software. And that's where you're seeing a lot of AI roll-ups, for instance, as well, in order to try and capture the opportunity in the space. So that's a bit of a different play, but we're also excited about. So very much, as I said, remains this sort of middleware layer, application layer where you have like deep understanding and build deep moats, and then also these sort of AI services layer, which is more emerging. And I think with all of that, you could also argue, as we've sort of discussed already, what's next for a lot of these software companies? And I think everything from an investor perspective really comes down to what is the core value that you're driving to these businesses that they want to pay significant ROI and money for. And that doesn't go away. So we've seen that with a lot of our larger stage software companies who found implementing AI into their product has been such a net new category creator, both in terms of the ability to go into new markets or unlock a different customer segment that they weren't previously able to. And the same is true in the cost base. So particularly coding has been like often the biggest use of value add. And also, frankly, for these bigger enterprise companies, is just streamlining internal processes, which in general, as a lot of these big software companies grow, can get very cumbersome and weigh heavily on the cost base. So I think software isn't dead. I think if you have, entrenched distribution, customer love, etc., these companies will have already built big and sustaining businesses. That being said, for the net new companies being created now, it's not just enough just to be a software company. You have to add materially more value, and your moat has to be significantly larger than it was before. And maybe my last point on that is then what do we look for then? What is exciting in terms of an AI company? How do we actually evaluate and engage with that? The big part is one, as I mentioned, is moats. So is your moat in data? Is it in distribution? Is it being in regulated industries? The second is what market are you actually in, and how does that deliver value? So this has been picked up already, but are you in a market that will expand with AI? Will it contract, or will it just redistribute value? Obviously, as an investor, you want to be in markets which are net expansion and doesn't necessarily just reduce the cost of that market to zero if it eats away all the software or all the people spend. And the last is you have to be a bit more opportunistic and think a bit more creatively in terms of how you actually evaluate these companies. As now you have companies going from 0 to 30, 50 million ARR in a year, in 6 months. And you have great enterprises who are trialing a lot of tools, budgets are growing, but 10 years, it still remains uncertain where a lot of these LLMs will go and how the sort of market structure will shape out fundamentally. So that's really going back into how much your customers love the product? Are you really embedded into their core systems? And that is ultimately what you can believe that you can build a big business out of. So I think, sort of cautious optimism, I guess, around AI. We're obviously very excited about all the use cases I mentioned. But same is true in terms of software. If you're already a big software business, it doesn't necessarily mean, if you're not just a workflow tool, that you can also add incremental value to the business. So that's how we think about it. Thank you.
Thank you, Phoebe. Very, very interesting. We're now going to turn over to some Q&A. I'd like to start this, as we're sort of focusing on how AI is transforming the enterprise and work, do a quick poll of the audience. So can people put their hands up if artificial intelligence has significantly transformed how you work over the last 3 years? Probably about a third. And those who it's changed a little bit, a third. And then not at all. Anyone not at all? A couple. Okay. Interesting. I mean, I don't know if we've ever seen such a significant change in the way people work, especially in sort of intelligence-led businesses. I'd like to start with a question which really looks at asset allocation. We've seen the big trades recently, in terms of the semiconductor growth, and obviously we've got concerns whether that capex cycle is sustainable. Like, obviously, the acceleration cannot be sustainable. At the same time, we've talked a bit about SaaS software and how you've had the SaaS apocalypse, and those businesses are potentially challenged, but equally maybe the valuations are looking somewhat more attractive at the moment. And then you've got the users, the deployers, and so on. If you take yourself 12 months, 12 months ago to today, has your maybe asking you, Fred, first, are you thinking about weighting capital any differently to where you were a year ago, given what we've seen in the markets?
Yeah, I reckon over the last year or so, we have probably just taken what we've done for the last 3 years a little bit further. So maybe 2.5, 3 years ago, we started to worry a bit about software. We've talked about what it means for coding, for the moats, for data. the ability to generate a lot of that data within tools like Claude as those models get more capable. So continue to underweight the software sector as a result. The other area that we've continued to underweight, we're also at historic lows for the fund, is the Mag 7. Now, coming out of the cloud optimization and COVID period, these companies were growing 20, 25%. They were in what was termed their get fit era. They were cutting heads, the margins were going up, and that's why those companies did so well for so many years. And arguably tech as a thematic was sort of listless at that point. So the Mag 7 performed really well. And now with AI, all of those companies have a credible bear case on them. So Apple, so far, let's say, have done nothing. Now TBC, what that means, are they going to partner? But if the Frontier Labs turn around and say you can't use our models, then that could be a problem for them. Or maybe the bull case is that they have a great new hardware product and they start to do well. Google have got their own frontier model, and they've got their own infrastructure stack. There's a big bear case around what happens to their search business as this AI boom unfolds, but there's a credible bear case on that as well. And then Amazon have got a great partnership with Anthropic, also have their own chips, but again, don't have their own frontier model. So they've got a partnership with Anthropic, but we've seen how that can unfold with Microsoft and OpenAI. So again, there's credible bear cases on all the Mag 7, so we've continued to underweight the Mag 7 and software as a result. And on the other side of it, which has been fun for me as a semiconductor analyst, is focus more on semiconductors, the hardware-led cycle that we've seen over the last 2 or 3 years. And that is not just in NVIDIA, Broadcom, AMD, that's also in names in Taiwan, in Korea, materials, all these various bottlenecks that are required to ensure that these servers can operate at a higher and higher level and can train better and better models. And again, I keep coming back to it, but it means the model can get better, they can do longer tasks, we move into agentic AI, where autonomous agents can do things for you on your behalf while we're all sitting here. And the crucial element of this for us is that unlocks what we would call non-human scaling, which is that you and I only have so many hours in the day to do work, but as we start to get to this agentic AI with these capable models, these models can work 24/7, 365. And that opens up a whole new sort of economic TAM for us. So continue to underweight Mag 7 and software and sort of move more towards that hardware and semiconductor.
And Phoebe, from your perspective, is Molten significantly changing its weighting in terms of new investments? And you talked about this actually at your Investor Day, but how do you value these companies? You talked about how these businesses can grow from 0 to 50 million very quickly, but equally, things change so fast. How secure are those revenues? And when you look at, from mainly an analyst who looks mainly at listed companies, if you look at the SaaS transition, that transition was hard won, right? A lot of companies made the transition from traditional upfront revenues, and their revenues dipped for a while as they secured longer term recurring revenues, and they got a valuation uplift initially to reflect that. But now those valuations have come down. How do you weigh up a fast, if you look at a fast-growing AI company versus a reasonable growth SaaS company, but that's traded down and is valued more lowly? How do you make that decision?
Yeah, for sure. I think in terms of maybe how we're thinking, or I guess the weighting of how we've looked at AI companies, obviously I think definitely has increased over the last year. I think there are two parts of that. I think one is, as I sort of mentioned in my sort of speech, is how you can augment existing workflows. So that's something that we've always looked at as thematic focused investors, typically starting with software companies, and now you have sort of AI plus software companies who are essentially doing that. And that has been, a lot of companies are building in that space across financial services, healthcare, climate, etc. The other area where it's sort of net new actually is more the ability just to create completely new ecosystems and industries around AI. So for instance, at the moment, area I'm looking more into is digital twins. So people in marketing, you can create like synthetic audiences. You can also use that technology to in economic settings and sell them to economists or governments. Same is true in terms of things like geo-marketing. So how can you better market through things like GPT or any of these frontier models? So these and this applies not just to enterprise or financial services, these sort of net new AI sort of ecosystems are emerging everywhere. And the infrastructure and middleware layer is obviously a key beneficiary of that. So those are the sort of two net new areas that we're seeing so much pull. That being said, there are also other big trends within European tech that have also are also something that we're excited about. So one is being more hardware-led, sort of space, anything around defense, European sovereignty. That's the other big trend that we're seeing. And it's real, and it's like a valuable trend as something that we've seen in all the macroeconomic issues that have been going on over the last 6 months. So I say as a team, those are like the bigger themes. How we play within that very much ties into, I guess, like how do you see value in these companies is really like one, really drilling down to like what is the real moat. Often, as with every venture investor will say, like you're backing great teams and great founders. So is this a team who is going to be able to navigate whatever the frontier models will throw at them and can really pivot their business? We've seen great success in some of our portfolio companies doing that already. And the second is, okay, so you have a moat today in your data, in embedding your workflows, et cetera. How can you really build that and sustain that over time? And the other part where it is true that there is a race to scale in a lot of industries. So you've seen this in the vertical software companies like Legora, Harvey, seeing the same with financial services, with companies like Rogo, Model ML. And there it's really landing with your customers and building a really mission critical and sticky product. And how you value that, as you said, like you do have to, as venture investors, have to believe that these companies can build big and sizable outcomes. Harvey, Legora, et cetera, have proven the ability to that in core verticals. Then it goes to how much of the market can you realistically capture? Is this a market that is going to net expand? Will it contract? And therefore that sort of ties into like how much you can really believe that these companies will be worth the exit. So at Molten, that's something we're actually very disciplined about, thinking about who would actually buy these businesses. Like a trend that we've seen, for instance, on the infrastructure layer. For instance, SAP just bought this company called Prior Labs in Germany. That was $1 billion acquisition. They raised a seed round 2 years ago. So you're seeing these like bigger acquisitions in the space. So it's like, how can you play within that, particularly some of the more typical acquirers versus building big standalone businesses. So it's a trade-off between all those different things, but you have to be more creative than looking at traditional software companies.
Thank you. And now a question probably more for Samir and Louise. We talked about the growth of the hyperscalers, and but also the growth that Anthropic and so on are seeing, which they're growing very quickly, but it's still a relatively low base in terms of the revenues they're getting. These players need to monetize their models, and we're seeing, as you mentioned before, a much more significant concentration in terms of the investment that's going in and the likely winners. How do companies, for you, Samir, how do you deal with that? If how do you deal with that exposure? And if we've seen instances, for example, of business models suddenly being compromised when API prices go up, or one of the companies stops selling its allowing access to its LLMs. How do you manage that risk and that concentration?
First of all, we don't touch any of that. We stay as far away from it as possible. We are not a CapEx-driven company. What I say is the more CapEx, the better. Please go ahead and invest, because we're right on top. And where we see the choke point is that Venn diagram between all of the infrastructure investment, all of the model investment, the platform investment, the tool investment, and real-life human work, and understanding how that actually happens. And that translation layer between the technology world and good old-fashioned, I think you called it picks and axes, but they're literally like old forms, right, in this world. People who knew how to shuffle a form from one desk to another and to translate that into what it means for an LLM. That is where we see the choke point. I don't really see us being super dependent on the advancement of these models. I think they will continue to advance and we will continue to ride on top. But I think they're all going to hit that barrier, and that expertise of translating technology into human work and monetizing it is where we're focused on. So to me and to our company, a strong partnership with these companies is important, without actually doing any of the CapEx investment.
Is there a risk that prices go up, though? as these companies look to monetize their models more significantly?
They could try, but I think there's enough competition out there that I don't think there is significant exposure, at least in the next 5 years till 2030, in our opinion.
And Louise, you talked about your ChatGPT visibility. Is that something you're seeing across the other LLMs? The other, are you overweight one or underweight the other? Do you look to get more diversity?
We see it across all of them, but I think ChatGPT was earlier to adopt from a consumer perspective. So it was the first model that was launched, and so consumers were using it more, doing more of their kind of research on it. And so we've seen that ChatGPT is still a higher proportion, but definitely was the biggest to begin with. We have a partnership with Google anyway, from an SEO perspective, where we provide our data to them, and they use Trustpilot reviews as part of the Google store ratings that you see in Google search. And so we've always had good visibility in Google search. I think we had something like 160 billion impressions last year through Google. And so actually then surfacing through Gemini, we've already got some relationship there. Unfortunately, the way that Google disclose the information, you can't split out what's Google search and what's Gemini at the moment, so we can't be entirely clear on how much of each. But yes, we are seeing the surfacing across all the models.
Very interesting. I can't tell if that is red or orange. It's red, I'm told. Okay. So I think we need to call time on the panel. Thank you very much for presenting a fascinating discussion, and there will be time to meet the panelists after the. Are we having coffee now? It's coffee now. In the coffee break right now. Thanks.